Good morning, everyone. It's Andrew Ruland here. This is our final sound check, and we will get started right around 11:05 Mountain Time. Thank you. Good morning, everyone, and welcome to Intelligently Profit from the Commodity Supercycle and Rising Interest Rates. I'm your host, Andrew Ruland, President of Integrated Wealth Management in Calgary. My colleague Sandor and I will be on the webinar today. Sandor will be doing the technical backup as he always does, as well as, of course, having been responsible for having done quite a bit of the research associated with what we're going to present here today. So jumping right into it, our focus today is that we're going to show you how to take advantage of the commodity super cycle and rising interest rates in a safe, structured, and quite sophisticated way. Of course, what we do here at Integrated Wealth Management is we do complete wealth management. We do everything in the context of a full wealth management plan with your family's life goals at the center. The vast majority of people contact us for this one here, managing your money. But it's important to get everything all pulled together into a fully synthesized or integrated package. And we, of course, serve clients throughout Alberta, BC, and even parts of Ontario. The reason why clients choose IWM, quite frankly, a shared worldview. A lot of our listeners are from Money Talks, a lot of our clients from Money Talks. We're very independent, non-mainstream, and we see the world as it truly is, as far as we can understand it. That is, we are data-driven as opposed to ideologically possessed. We offer very unique investment solutions, and of course, our service model is very personalized or boutique with customized portfolios for each and every client. So today's agenda, we're going to talk about the decision-making challenges for investors. We're going to talk about some themes behind the commodity super cycle and how to invest in it. Those include money printing, the Build Back Better label, and infrastructure spending. And we're also going to talk about exactly how we implement these forward-thinking portfolios, including the strategic investments in commodities, but also looking at alternatives and stocks you can tolerate. At the end of the formal presentation, which we think is going to take somewhere between 45 and 50 minutes, there will be a Q&A session. Depending on what type of device you are watching the webinar on, there will be in the GoToWebinar box, probably on the top right, there will be a question mark icon, and that widget should be the means by which you are able to actually put a question in, and we will try and curate the questions. Sandor will curate the questions while we're going. Take a very brief break at the end of the formal presentation, and then we'll get to your questions. All right, so talking about the challenges facing many investors, and particularly we're going to talk here about when it comes to investing in some higher growth areas. For a lot of people, it could be a life stage issue. Early in life, we don't have you know, enough risk capital. You shouldn't risk your early capital as much as that is kind of the typical way people are advised to do things. And a little bit later in life, as you get closer to retirement or in retirement, it feels riskier, and it's tough to know how much should be put at what type of risk. We also know from a lot of the clients that have come to us through the Money Talks channel, especially, that many investors have not benefited from major trends in the past. That could be things like pops in the oil market, could be in various commodities. And of particular note would be the fact that many investors did not benefit tremendously, if at all, from the last major bull run in gold and gold stocks from 2001 through 2011. In many cases, people are unprepared to click the buy button early in an uptrend because they're just not certain or prepared. They end up buying too late, and they could end up having a round trip with their investment. That is, they buy it late, it goes up and they hold on to it. That's a round trip. When they sell out at the same price they bought, but sometimes they also will hold on because they still believe in the theme and end up in a worse situation. And this is one of the areas in particular where we start to see that perfectionism really is the enemy of the good. A lot of people go about trying to find the needle in the haystack versus finding the right haystack or sector in this case. And in many cases, they're trying to select the exact top or bottom, looking for the exact best time to buy or sell. And it's interesting and very important to remember that there's only ever one trade at the top or the bottom of any given market. So the chances of getting that are very, very low indeed. So what we want to talk about here is how we can make some progress in how your money is invested, particularly when it comes to the commodity super cycle. And if you want progress, it takes three equal parts of time, money, and a third thing. Time. This webinar is an example, investing some time. Your money is obviously on the line, and you have money at risk when it comes to all these investment decisions. But what's the third component? Well, the third component really comes down to human nature. And that third element is a willingness to change. We must be willing to actually do some things differently than we have been doing them in order to achieve the benefits associated with improvement. So on the right there, you can see that there are a few issues that we hear about a lot. Typically, there are folks who have trouble because they're sitting in cash or GICs and can't seem to get out of it because they're looking for the perfect time. Some people are just continuing with ineffective investing habits. Maybe they still believe in bonds as government bonds as a great investment or something like that. And ultimately, what it comes down to is that most people continue with suboptimal results with a current advisor in many cases, and that's a separate issue all by itself. But ultimately, what we have to do is we need to be willing to make a change in order to get the progress. So we're going to talk today about forward-thinking retirement portfolios. And you can see three general categories listed there on the left. There's the stable income generation, income and growth, and then opportunity seeking. And the first two are part of what we call the core of our client portfolios. Every one of our clients owns the core portfolio that you see there with alternatives and corporate bonds and stocks you can tolerate. And the explore part is what we're going to feature today, which is the opportunity seeking element of a client portfolio. And that's in growth stocks, small cap cyclicals, very particular sectors. That's what we're going to focus on. Now, a lot of people are drawn to this area of things, even though it should not be the biggest part of their portfolio, but it's the fun and exciting stuff. So today we're actually going to eat our dessert first, which is the fun stuff on the Explore, but we're going to loop back and talk about how it fits into a core and Explore strategy altogether. So some of the major themes driving the commodity demand, I would put them in two broad categories. One is massive stimulus, the other is the Build Back Better theme. So on the massive stimulus side of things, of course, we have fiscal stimulus driven by debts or deficits and accumulating debt. And the second category, which comes in typically a whole lot faster, is monetary stimulus by central banks. The other theme, of course, is the Build Back Better motto that we've heard coming out of Dr. Evil, Mr. Klaus Schwab, and the World Economic Forum types, and it seems to be getting used everywhere. But behind that are major meta trends in electric vehicle or EV growth, also investing in clean energy, and of course the very necessary spending or investment really in infrastructure. So let's talk a little bit about fiscal stimulus. You heard Mike a little earlier today on with the Auditor General of Canada, trying to walk the balance beam of not being too political. But here's the reality of what has happened with our COVID spending. You can see that back in 2007, 2008, we were just over $1 trillion of federal debt, and it has escalated, and it's escalated a little bit more here under the Liberals. But then, and then of course we've got the COVID spike. So this would be another form of the COVID jab. So we're headed towards a little over 2 trillion. So about a 97 or 98% increase in Canada's federal level debt just since the financial crisis. That's a big challenge going forward, of course, because they're going to be looking for tax dollars. And here we have the US total public debt, and it shows quite handily here debt versus GDP. So you see this line here is GDP in the US, and for quite a long time, GDP has been actually above the total public debt. Well, we started to cross over in here. The GDP was growing quite nicely here, but of course, as it seems under pretty much any administration in the White House or in Congress, the debt continues to grow faster now even than GDP. And of course, here you can see us going down with the major lockdowns starting about a year ago. And of course, the debts and deficits went way up. And so we're projected in the neighborhood, I think, of about $28 trillion of public debt in the US by mid-2021. So there's your massive amount of fiscal stimulus. That's borrowing, borrowing from government spending. Some of it ends up being productive, but of course a lot of it gets lost in translation, shall we say, from taxpayer to project. So this. Looking here also, second part of the massive stimulus part is looking at central bank stimulus or monetary policy. We can see here what an incredibly large spike has ended up happening here at starting in about 2020. In fact, what happened is that there was coordinated central bank action on March the 23rd of 2020, which ended up marking the bottom. That was actually when Jay Powell came out and said, basically, nothing is off the table. The Federal Reserve will do anything and everything it takes. So what ended up happening is that they put in, the US Federal Reserve actually did about 4 times the total stimulus that they did during the 08-09 crisis, and they did it in about 1/10 of the time. And that central bank action, along with coordinated activities, Bank of Japan, European Central Bank, and Little Old Bank of Canada, helped to create the floor for the market. However, we're still left with this incredibly powerful spike in monetary supply, or the M2 money stock. So doesn't that automatically lead to widespread inflation? Well, in fact, it doesn't. You see there up there at the top right of the screen that that we have a little bit of an increase in inflation, but there's this automatic expectation that increase in money supply immediately leads to pervasive or widespread inflation, and it's just not so. We'll talk a little bit about this more in a moment, but really it results in pockets of inflation, not broad-based inflation. And that's because of this factor here, and it's the velocity of money. So really, if we're going to have inflation, we have to have an expansion of the money supply, but we also have to have significant velocity of money. And we don't right now. So you can see here at the very end what happened 2020 especially, and even in 2021, is that even though the money supply has expanded very, very substantially, it's not moving. So basically, if that money's not moving, it's not chasing the number of goods and services. And the reason it's not moving very quickly is quite simple, that people are uncertain about the future. They're sitting on cash. They're not allowed to do a lot of things like travel, some different things like that. So even though the money supply has expanded, since the velocity is low, we don't have widespread inflation. What we have instead are pockets. And the pockets of inflation are really about where capital is flowing into. You've heard that theme many times from Mike and from Martin Armstrong on his radio interviews and his various conferences. And when we take a look at the pockets where it's flowing, we look at these broader themes. So Build Back Better, the infrastructure spending, and also ESG. And now, why do I bring ESG into this? Well, that is an important component to kind of refining where things are going to go. So ESG stands for Environment, Social Justice, and Governance. And it's very definitely like a corporate scorecard, but it's really something that's really come out of the green agenda, or the woke crowd, as I quip there. And as you can see there with that graphic on the right, investing in Canada here, there's large elements of social spending, but public transit, green infrastructure, social, whatever that means, trade and transportation, that's pretty straightforward in terms of real infrastructure. And then there's rural and northern communities. A lot of that is actually going to be about building out services there, but also building out broadband. But whenever it comes to government spending, we need to be very, very clear that this new agenda, whether or not we agree with it, is part and parcel of where that money is going to go. So harkening back to Jim Dines, it's very important to remember that there are trends that we don't necessarily agree with, but we can invest in them. And the way that he characterizes it is that we want to ride the herd without becoming one of them. As far as infrastructure spending goes, there's no doubt that there is a major gap. You see here this current trend line. This slide was developed quite a while ago and showed the trend even back then. There's the trend in terms of what investment was actually going into it, and the blue line at the top here was the investment need. So clearly there's a gap, and it's pretty well understood that we do have an infrastructure deficit, and that deficit is much greater actually in the US than it is here in Canada, although we certainly have our own infrastructure deficit here. So Build Back Better. In the US, the Dems announced a $2.25 trillion infrastructure plan, and more is expected. Depending on whose analysis you listen to, somewhere between 50 and 70% of that money is actually going into infrastructure build out, including electric vehicle fleets and job training. In Canada, in 2016, they announced 180 billion in infrastructure investments over 12 years, and 96 billion has been newly announced by the Liberals, including on October 20th. They prioritized 10 billion in infrastructure spending for COVID recovery. So, what does it take if we're going to build back better? If we're going to build anything, it takes stuff. It takes raw materials. So this is an important part of the theme, understanding where we can profit from this trend in spending, but also in kind of a different take on building out what the economy looks like going forward. So first of all, let's look at oil and gas. The first market that Marty covered at the 2020 World Economic Conference was oil and gas. And he said, much like Winston Churchill quipped about rumors of his demise have been greatly exaggerated. The first thing that Marty said is that the death of oil and gas, or traditional fossil fuels, has been much exaggerated. And that's a really important concept, both for Alberta and the country as a whole, but for the industry. And fairly recently on Money Talks, Joseph Schachter talked about seeing $100 oil within the 3 to 4 year time horizon. Heard Victor talk today about where oil is, and Joseph is expecting after we get a bit of a pullback here, hopefully in the coming months here, that we're likely to see $70 oil pretty well through the end of the year. That's obviously constructive for the Canadian oil and gas sector, also in the U.S. So this graph that we have here is world oil demand, and it was actually done back in, looks like about 2016, 2017. The reason we put up this graph, even though it's a little bit older, on the right-hand side, you can see all the different agencies estimating what global demand is actually going to be. And the one in fuchsia at the bottom, the International Energy Agency, even their most pessimistic view of oil and gas demand, meaning there's a full implementation of the Sustainable Development Agenda, which would be Build Back Better, that there's still a pretty substantial gap between what is going to be needed and what we would see if we had a 3% annual decline. And of course, that gap gets filled by energy companies reinvesting in drilling, exploration, and bringing things to production. So looking here at the U.S. energy sector, we can see that, of course, famously, oil went negative for immediate delivery, or the spot price went slightly negative here. Would have been, I think, the 21st or the 22nd of March that happened. And we've had a little bit of a bounce followed by a decline. And we've had recent very strong increases here. And we're actually waiting right now for a bit of a technical entry point for getting back into energy stocks. Won't necessarily be in U.S. energy stocks, could also be in Canadian energy stocks. I show the U.S. energy market because they have fewer constraints associated with the political environment. Next subject here is looking at metals, the first two kinds, talking generally here about industrial metals. It looks like Sandra put a quote up here: if you're doing infrastructure build out, you need raw materials. He was actually quoting me. That's really just a paraphrasing of everything that you heard from the keynote speakers and Mike himself at the February 5th and 6th World Outlook Financial Conference here back just a couple of months ago. And I've chosen here to show projected copper demand because it's probably the best known and obviously the most important of the industrial metals. You can see over time that there is massive increases in projected copper demand. And in fact, overall, it's anticipated that we'll have a 5% year-over-year increase in demand versus supply increasing only at about 2.3% year-over-year. And a big part of that is electrification of the vehicle market. That's not all of it, but it's a very important part of it. And of course, with all of us carrying devices everywhere we go, those require electricity, and electricity generation, whatever form, requires copper. So looking here, this is a 5-year chart. It's done weekly, and I've taken off the typical 50 and 200-day moving averages for clarity. So we can see here that the industrial metals up here in the top right-hand side, we're back pretty close to breaking out to a new high. This is an area where we see that there's going to be pretty substantial long-term opportunity. But because it's a pretty rocky ride, one of the things that we've done is we've actually chosen an actively managed ETF. It's managed by a group here in Calgary, traded on the New York Stock Exchange. And it's a long-short strategy in commodities, and it's about a third in metals, both industrial and precious, energy, so oil and gas typically, and also agricultural commodities. But this is an area where we've seen a very significant recovery from the March bottom, basically close to doubles. And so with the long-short strategy in place, we have positions in that active ETF. So switching over to precious metals, which Mike had mentioned a little bit in our interview a little earlier today, they are considered, of course, a longer-term safe haven against fiat currency devaluations. And of course, today we have digital currency considerations, and those are separate from cryptocurrencies, but basically going to a digital style currency from the central banks in each country, as opposed to our current system, which is basically more or less locked up by the retail banks, and of course we still have a cash market. Precious metals have certainly seen a lot of competition recently from cryptocurrencies. It's a very, very similar type of mindset that goes with investing in crypto versus investing in gold. And in fact, a lot of people would own both. And of course, precious metals are highly cyclical, but we have actually some opportunities that are emerging. I alluded to that in the interview with Mike this morning. And in fact, about half an hour ago, we actually got another email alert from Institutional Advisors. That's Bob Hoy and Ross Clark's group. Very, very solid technical and analog work when it comes to various sectors. And we actually have a sequential buy set up for gold and silver happening. It's really just developed in the last few days. And our preference is to take a look at gold stocks as opposed to the metals themselves, just because we get more upside leverage, just the same as you get more upside leverage typically with an oil company than you do with just buying crude or natural gas. So in the right-hand side here, you can see that there's a roughly, you could see a trend channel on the bottom here and on the top. And it looks like we're just about to make a little bit of a breakout to the upside. So we're going to be on the alert for buying that breakout here over the next week or so. Food and agriculture. This is a really, really big one. And of course, the tailwinds that we have for this are very considerable. There's long-term population growth, especially in China, India, and Africa. And not just population growth, but also increases in protein consumption. There's factors associated with changing climate, and I'm not talking about global warming specifically. I'm actually referring to some of the climate change that we're seeing, particularly in the northern hemisphere. Martin Armstrong has documented this very well. We are in fact in a cooling cycle as part of a solar minimum here in the northern hemisphere, and that has an effect on crop yields and crop failures. We've also started to see more recently that there are significant supply chain vulnerabilities, particularly about 10 or 11 months ago. We started to see some supply chain vulnerabilities, particularly around the processing plants because of COVID breakouts. We had some of those in the States, but we also had them here in Canada with the JBS plant in Brooks, the Cargill plant in High River, and the Olymel pork plant in Red Deer, actually. So those are examples of supply chain vulnerabilities, and they have been certainly driving those food commodity prices up. There's also the factor of increasing regulations, and this is in particular in the Eurozone, where they're getting a little bit more closed, and in fact adding additional food safety regulations on top of what they've already had for quite a long time, under the guise of being driven by the COVID situation. Not sure how that really relates, but they are definitely driving regulations up, seeing that having an effect on food prices. And of course, longer term, as we see energy prices rise, as we talked about earlier on our way back to $100 oil, we have rising input costs. And of course, those input costs will drive the prices of commodities much higher. So we take a look here at agriculture stocks, and you can see going back all the way about 5 years or so that this particular sector was on a steady increase or steady incline, a very nice, stable, smooth, but growthy market through until the COVID situation happened. Pardon me, major declines, of course, and we've moved on to new highs, very significant new highs. This is a sector that we definitely want to be adding to, but of course we want to make sure that we are being very patient with adding it into client portfolios, and so we're waiting for a pullback in this particular sector. Next sector I want to talk about here is rare earths and other scarce metals. Now, rare earths, you may recall from the Dines letter or some of the interviews that Jim Dines did with Mike on Money Talks in previous years, that it's a group of about 17 metallic elements. Many of them are used in goods that require them to function or enhance their function. And you can see they're pretty much pervasive in all of the modern conveniences and all of the wonderful modern things that we count on, including obviously our mobile phones and solar panels and even welding goggles, but also wind turbines and fluorescent lighting. So there's a lot of industrial uses, and especially the biggest one is really, again, it's the increase in the electric vehicle market. And the more that we proceed on this digital transformation, as we've characterized it here, the more we need these rare earth and other scarce metals. Now, there's a couple of the two primary scarce metals that we're talking about here really are cobalt and lithium. Lithium has been on a particular tear the last year. We're not going to invest strictly in lithium simply because it's incredibly volatile, and that's a little bit too much risk to concentrate in one position here. But it's all part and parcel of how we're approaching this big story of investing in the commodity super cycle. On the left here, you can see the electric vehicle penetration rate that has been estimated. Indeed, while Tesla has obviously been the big headline story in terms of its incredible stock price growth and it's very media savvy and I'll say media magnet Elon Musk, the fact is that companies like Volkswagen, or as they quipped recently, Volkswagen, is actually making a major move into the electric vehicle market. And regardless of what you think about electric vehicles versus internal combustion engines, this is a trend that is happening. So we want to ride the herd without necessarily becoming one of them. And on the right-hand side here, you can see the lithium supply and demand balance. You can see here this was done a few years ago, but if the electric vehicle market actually, if market penetration does escalate the way we're seeing over here as projected by UBS, we could see an even steeper demand here on the lithium side of things. Excuse me. So there's also some headwinds that we have to be aware of. There's some big challenges when it comes to sourcing supply and scaling production. There's also significant geopolitical issues, particularly when it comes to rare earths. China has somewhere between 94 and 97% of the rare earth production that actually happens within its borders. And they've also bought up a lot of properties in different parts of the world. And then when it comes to things like cobalt, the single biggest source of cobalt in the world is actually the Democratic Republic of the Congo, rather. And unfortunately, their labor standards there don't match anything even close to second world conditions, never mind first world conditions. Most of the cobalt that actually goes into an electric vehicle or any other major product that requires it is probably mined by a male child between the ages of 8 and 12, working 12-hour days in bare feet, literally climbing down holes with ropes and no breathing protection. So that has its own limitations, and of course it has its own ethical concerns. We also have trade wars, and we'll see how those things develop. Trade wars were, I would say, a bigger issue under the Trump administration based on their style of dealing with other countries. And of course, I just mentioned the human rights concerns. There's also environmental concerns with the way that cobalt is mined, but also with rare earths, because rare earths require a lot of very harsh chemicals to separate the rare earths out from the ore that is mined, and those tailings are extremely dangerous. So those are headwinds with it, but it also means that it's a very limited market, and there's some upside opportunity. So we look here at rare earth stocks. We can see that they peaked back in 2018. came back down through here, made a bottom with the March 23rd low, as did pretty much everything else. And we've come back up, and we are in fact back to, or we actually went back to a new high. And we've since retreated about 29% peak to trough, and we're starting to see a little bit of a bottoming action, and so that's an area that we're going to take a look at here in the next little while. Now let's talk a little bit about clean energy or renewables as they're referred to. You can see here the traditional electricity generation driven by hydro. You can see some slight increases here. Natural gas increases. It's not really getting its due, I would say. Yeah, it's not really getting its due as a transition fuel, which I think it truly deserves to be. And from a coal perspective, we're in a sunset market, despite the fact that China actually built more coal-fired electricity plants last year alone than Europe has in all of Europe existing. But the big trend here, of course, is wind, and PV stands for photovoltaic. So those are the projections for its growth. So what do we need for that? Well, we actually need some pretty important things, and we'll get to that in just a moment here. So taking a look here at clean energy stocks, and this is a U.S.-based ETF, and it's actually been around for quite a number of years. Was starting to make some growth here in 2019. Spiked early in 2020 and fell by almost half, as you can see there in the March crash. But since then, it has gone on a pretty significant tear to the upside. What I'd like to also point out here is the very, very significant increase in volume. So there's a tremendous amount of interest in this particular area. Now you can see that it made a peak a little bit earlier this year. And from peak to trough, it went down about 34.8, call it 35% from peak to trough. And our portfolio managers actually just started buying this on Thursday, and will complete the second half of the buying on Monday. So this is an area that we think has a lot of legs longer term, and the ETF that we're looking at using is actually one that was recommended by Mark Leibovit during the World Outlook Financial Conference back in February. We do know, however, that clean energy has some practical limitations. It's not a panacea. Of course, there's the limit in terms of accessing the rare earths and scarce metals. There's also the bigger and far more daunting issue, I would say, of the fact that solar and wind are simply not reliable for providing baseload. And baseload is it's the electricity that has to be there all the time, just for running everything that goes on in our world that requires electricity, which is almost everything. And the reality, of course, is that the sun doesn't always shine, and solar panel efficiency in terms of conversion of light energy into electric energy still lags behind. And of course, with wind, the wind doesn't always blow. You might not think that down in Lethbridge or Pincher Creek, but the reality is that wind does not always provide electricity. So what is the proper mix? Well, there's a lot of opinions on that. Thinking that we're ever going to get to 60 or 70% solar and wind is just not realistic, especially in northern climates when it comes to solar. And depending on who you listen to, the range is probably somewhere down in the 30 to 40% in terms of the ultimate long-term mix. Sorry, I'm just pausing here for a moment because a lot of listeners have actually been sending in questions, and we just wanted to let you know that we're going to talk about the core as well. And that's going to be in the second half of the presentation. All right, So of course, when it comes to the real clean energy, that is actually nuclear. Very familiar with the story from being a longtime subscriber to the Dines letter. And the reality is that while most people don't think of it, there's 94 operating nuclear power generation plants in the US and 6, in fact, here in Canada, 5 in Ontario, 1 in Quebec. And there are still some discussions of actually adding a nuclear power facility here in Alberta, the home of the oil and gas sector in Canada, which might seem surprising to some. But the reality is that nuclear power is actually the lowest emissions per kilowatt hour generated. It is the most reliable provider of baseload electricity. It's incredibly cost efficient, even when you factor in the upfront construction costs. But some of the most important developments have actually happened here in about the last 10 or 15 years, where we have 4th generation nuclear power plants. They're much smaller in scale. They're because they're much smaller in scale, they're faster to construct. They're safer than Gen 1, 2, and 3, so that results in faster approvals. And one of the greatest things about the 4th generation nuclear power plants is that they have the ability to actually reuse quote unquote spent fuel rods from earlier nuclear plants. So nuclear waste is always one of the things that that people have brought up in terms of a problem with nuclear power generation. But the 4th generation nuclear plants actually address that, which is awesome. So the ultimate in fuel recycling. So looking here at nuclear and uranium stocks, we've had a nice run here very recently, and we're waiting for a little bit more of a pullback to get involved in those. And we think that's an area that has a lot of long-term upside potential, because ultimately the world is demanding more and more in electricity, and we just have to be aware of that and find ways to provide it. So as we talked about here, our focus was to show you how to take advantage of the commodity super cycle and rising interest rates in a safe, structured, and sophisticated way. So let's get on to the implementation and how we're going to actually do it. So we talk about executing investments in commodities. First thing is that it has to be a proportionate investment based on on the details of your particular financial situation. So it's your income level, it's your time horizon to retirement, it's the size of your investment portfolio, it's the income requirements that you're going to have for it, and also your sleep tolerance in terms of volatility. So I bet you didn't think you'd hear the term size matters, but that is very, very true here on investing in these more volatile areas. We've chosen to use exchange-traded funds and niche funds to eliminate single company risk, and that's all based on the concept of, instead of trying to find the needle in the haystack for a major home run, we would just like to get some added growth out of it by finding the right haystack. So with the development of niche ETFs, we're able to do that. And basically everything that I've shown you so far today in terms of charts of investments, those are all ETFs. And of course, it's not just about what you're investing in or getting the size right. It comes down to portfolio management skill. So what we have been doing is going through the process of filtering research and the noise to select the individual securities. There's lots of options within most of the markets that we've talked about. We've chosen what we think are the best and the most pure play and focused. We do a lot of technical analysis to inform trades. The chief investment officer of the portfolio manager that we're working with on this is extremely competent with technical analysis. In fact, before he came to this partner firm that we work with, he was the head of North American equities and the derivatives book for one of the big 5 banks here in Canada. So very, very skilled with technical analysis. And of course, there will be active management. So we won't simply be buying and holding these for the next 2 or 3 years. There will be some active management involved, and of course what goes along with that is having to have a tremendous amount of discipline. So that's the dessert that we've been talking about. Let's go back and talk about how this fits within the concept of the core portfolio. So again, we've just been talking here about the explore part, the opportunity seeking, but of course we need to have a really strong core. Just like a healthy and strong body has a strong core, your portfolio needs to have a strong core. And that's made up of stable income generation and income and growth, or stocks you can tolerate. So we also mentioned that, and this is a theme that we've heard a tremendous amount about recently. Mike, in fact, talked about it today in terms of the losses in bond holdings that have taken place since August of 2020. So this shows an increase in bond yields from 10-year U.S. Treasury yields from 0.52% here, bottom August 4th of 2020, and going through to the end of March of this year. And it was 110 basis point increase in yield. So this is the only chart that I've used that is not a 5-year chart. This is basically a 1-year chart. So I'm pointing out that here is the bottom in yield. Okay, so we've gone up about 110 basis points. And what does that mean in terms of what does your bond portfolio? Well, this is a 10-year continuous contract for 10-year bonds. We look at the peak here, which would have been right around here in August of 2020. And we can see a pretty substantial price decline from the 140 neighborhood to 130. And that in fact represents a 7.14% loss in the value of a bond portfolio. That's really substantial. That's why Mike and Marty and we keep on talking about the risks associated with being in government bonds in a rising interest rate environment. Now, of course, the way the bond pricing model works is that the longer you are from maturity and the lower that the coupon or the interest yield payment is on the security, the more volatile it is. So while we've seen since the bottom in yields or the peak in prices in 10-year bonds, a 7.14% decline in the value of 10-year bonds, when we go a little bit further out onto the 20-year bond side of things, here's our peak here's our peak right here in August of 2020, and you can see what a precipitous drop that is. That's just over a 21% decline since the peak in bond prices, or the bottom of yields, in August of 2020. That is substantial, and that's already substantial, but you ain't seen nothing yet. Back in the October World Economic Conference back in October of 2019 in Orlando, Marty gave a very, very stark warning about bond prices. And I'm paraphrasing here, but he said when the game of musical chairs finally ends, we could see treasuries go no bid and gap open lower, and we could see losses in 10 to 30-year treasuries in the range of 30 and 40%. So this is why we think it is so absolutely essential that people have alternatives to government bonds. And we'll talk about our solution here in a moment. The trigger that Marty's talked about is when we get to a tipping point of a collapse of confidence in government. And that typically happens not at the 50% mark, but typically at about 45%. So with the expansion of government debt and government involvement in our lives, we can see that there's probably been a little bit of a delay in the tipping point of confidence in government, but I don't think it's very far away. So our solution is stable income generation. The higher the yield, the higher the overall return. But what also happens is that a higher yield results in reduced portfolio volatility. So dividend or distributions from your stable income generation adds stability. That equals durability. So when portfolios decline in crashes or bear markets, high yielding portfolios decline a whole lot less. So this allows the portfolio manager to manage risk in real time without being forced to sell holdings when they're down in order to meet clients' household income needs. That's very important for those in retirement. So our solution is private alternatives, and they increase overall portfolio return because they generate between 6 and 9%, depending on the type that we're talking about. And what happens with these is also because they are short-term loans, business-to-business loans of different types, the yields rise with inflation. So they're very short-term. So there's a little bit of a lag as interest rates increase and inflation goes up with it, perhaps. But the fact is that over time, that yield is going to go up along with the increases in interest rates. Also adds diversification that reduces risk and helps to protect capital during periods of market declines because they are not correlated to market movements. Now that's an incredibly brief synopsis of the benefits. And it's mostly in the private credit market that we're looking. We don't want to spend too much time on this just because we have time constraints. But I would also like to refer all listeners to our webinar and video library on our website. That'll be included in a follow-up email. And we've talked about alternatives on several occasions, and you can find those in the video library. Of course, it's all free to view. And the last thing here is what we call stocks you can tolerate, or the income and growth section. And this is our actively managed equity portfolios where there's lots of risk mitigation, tactical use of cash, raising cash, trimming positions, adding back when things are lower, lots of diversification and active movement geographically in between sectors, and currency hedging. And as well, when things look really overstretched, the use of put options to dramatically decrease the downside volatility. And of course, there's a combination of fundamental and technical indicators. And the most important thing to remember with all forms of investment risk is that it is dynamic. It is not fixed, which is why it's important to have a discretionary manager who can actively manage risk in real time. Because when price is high, risk is actually high, and when price is low, risk is actually low. So we want a manager that's actively involved in taking risk down when everybody's all excited about trees growing to the sky and everything else, and then when Chicken Little seems to be front and center in financial media, that's the time you want to be buying. And we focus typically, most of our portfolios are overweighted to the dividend grower style. We also have a momentum style, but that's typically a smaller portion of portfolios. And the reason is best illustrated by this graph, this grid. We've seen this done many times. This one from Ned Davis Research has been updated to include, it goes all the way from the 31st of January, 73, all the way to the end of 2020. And you can see here on the vertical axis that we're talking about return here, so we want to be higher on the return axis here, and the closer we are to the left here, we have lower risk. So this is higher risk, lower risk, higher return, lower return. And the dividend grower approach to things actually is the top quintile of long-term performance, including reinvested dividends, and it is the lowest quintile of risk. The reason why more people don't do this and get the benefits of the dividend grower model is human nature, because we're always concerned with shiny objects, and dividend grower stocks, grower portfolios can actually be a little bit boring, but we'll take boring because it's effective. Okay, so our focus today has been to show you how to take advantage of the commodity super cycle and rising interest rates in a safe, structured, and sophisticated way. Hope we've delivered on that. Believe we have. And of course, if you want progress, you have to be willing to change. That's the biggest thing. You've got to be able to take a little bit of a leap of faith. We don't think that blind faith is a good way to make decisions, but making intelligent, well-informed decisions. So whether you're stuck sitting in cash because you can't quite find the right time to get in, you might have some other ineffective and perhaps even financially self-destructive investing habits. And for a great many people, because there are very few independent, truly independent advisors around like IWM and our partners, the fact is that most advisors don't have the capability of doing the things that that our managers do, and we're willing to go there as long as it makes sense. And of course, our job is to also help to make that change easy, and we can help you out in a variety of different ways. We provide a complimentary consult, happy to discuss your situation, do a portfolio review, and even provide some ideas to improve your financial security. When we're finished the webinar today, when you depart from the webinar, there will actually be an exit survey. That's a great way to let us know if you'd like us to contact you. There's our contact information as well. And of course, we'll be sending out a follow-up email with the webinar recording of today's presentation, and links to some of the videos that we've discussed. And you can sign up generally for our video and webinar library. We have quite an extensive library that we've built up over the last 4 years or so, going all the way back to Straight Talk for Financial Independence, a series of 7 that I recorded back. That would have been actually in September of 2017. And you can also follow us on Facebook and LinkedIn, as long as they allow us to be on there. And we also have a link to our financial readiness assessment. So thank you very much to everyone for your attendance. We see that almost everybody that started to listen has stuck with us, and we will pause for about 1 minute, and I will take my breath, or take a breath, and Sandor will come back in to our broadcast room here and bring in some of the questions that we'll get to. All right, thank you. We see that most of you have stuck around after our little pause here, and we're going to try and get to as many questions as we can. If we don't get a chance to cover all your questions, we'll certainly be getting back to you on email to try and answer them. So starting out here first, what countries' currencies will best retain its value with all countries expanding their money supply? That's a good question from Bob. We think that longer term, the US will eventually cease to be the world's reserve currency, but not until it does. So the way that Jim Dines refers to currency devaluations is a race to the bottom. And that's kind of contained in Bob's question there. Over the course of the next few years, I would certainly have more confidence in the US dollar, because it is used in so many international transactions. That has started to erode in the last number of years, particularly with oil and natural gas being traded in euros and yuan, and perhaps even in some of the local currencies in the Middle East. So that is starting to erode, but as long as most of the world's trade is actually defined in US currency, we think that that's going to continue. Marty's talked about some different solutions that are likely to come down the line, and it'll probably be some kind of a basket of world currencies. So you know, with the yuan, the yen, the US dollar, and the euro probably being the biggest components of that. It's an important question, and it's one which ultimately has it has yet to be answered. So it's one of those questions that it's kind of stay tuned for more to see how things actually develop. Next question here, gold and silver are tanking in spite of stimulus money printing and the stock market is going up. What's happening? Also, what's your outlook for the platinum group and rare earths? Well, I'll answer the second part first. Platinum is it's considered a precious metal, but of course it is primarily an industrial metal, very important for catalytic converters for emissions reductions. But it is also it's precious because it's extremely rare. Platinum, I think, is going to continue in probably a stronger bull market even than gold and silver because of its industrial uses. And rare earths, we're very bullish on them longer term, and that's why we included them in today's presentation. And our approach is to actually look at investing in a basket of rare earths producers. First part of the question, gold and silver tanking in spite of stimulus money printing and the stock market going up. I think part of it is definitely because the typical precious metal investors have been having very good success, and success breeds more investment in the cryptocurrencies, in particular Bitcoin, of course, with Bitcoin having gone up to over $60,000 US. And that's the investor in the typical investor in cryptocurrencies are wanting to keep their investments outside of the purview of governments, and so there's the big draw of that with cryptocurrencies. But I don't have a lot of clarity around the crypto market longer term. I won't claim any expertise except the one proviso, my one caution is that if governments decide to outlaw it or ban it as a form of valid payment, then that could end the crypto market's rocket ride up very, very quickly. With gold and silver, slightly different takes. Obviously, gold has had a rough ride since 2011. We had a bit of a recovery here in the last 3 years or so, but in the last while, we've been struggling to move higher. I think it's more or less a function of where investor confidence is. Silver, longer term, we think has a more upside, particularly when it comes to buying in the physical market, because silver is much easier to use as legal tender if we ever get to that stage. Offsetting that is the fact that if you want a significant amount of silver, you need a significant amount of storage, so it's pretty heavy. And on the gold and silver market, we actually think that that we're at a shorter term buying opportunity here. That doesn't necessarily mean that we've reached kind of a major breakout back to the upside, but as I mentioned during the webinar, probably before this question was asked, it looks like we're getting to a buying opportunity there, and our preferred approach is to use ETFs that invest in gold stocks because we get much more upside leverage. So what is the highest percentage you recommend in the commodity sector? I'm going to sound like a lawyer because the answer is it depends. And I myself, I'm a very growth-oriented investor. I have a very growth-focused investor personality. I have a much higher percentage that I would actually ever recommend to my clients. I have about 35%, for example, in precious metals miners. But that's much higher than most people have a lot of faith in. And I have about another 20% or so in the commodities area, specifically in the core and explore strategy that we've discussed today. I have my own money in there. So I'm at just over half, but I'm also in my highest savings years, and volatility doesn't bother me. So for most people, it's probably going to end up being somewhere between 5 and maybe 15% of an overall portfolio. But again, It depends on individual circumstances, like we mentioned a little bit earlier, and happy to talk with you about that if you'd like us to. It says, is this fiscal stimulus from government or is it private investment? So when we talk about fiscal stimulus, that means specifically public sector spending. So that comes from the government. Now, when there's confidence in a particular sector, you also get private investment there as well. And in fact, many times there is more private investment like venture capital that goes in there first. So I'll make reference back to the clean energy stock basket that we showed a little bit earlier. It's been around for I think 7 years now or so, and it has been attracting some volumes of new investment from the private sector, individuals, and it's going up very dramatically. So it's always a combination of the two. But frankly, I would follow the path of private investment rather than government investment, because government has typically the governments are horrible when it comes to picking who the best investments are. They're terrible at picking investment winners. So the question here, capital flows into pockets is based on the 2017 budget, quite correct. How do you think the new budget on April 19th will be impacted? Well, Judy, I think it's going to be even woker than what we showed you there on that slide. Tons of stuff that's going to be based on equity, diversity, equity, and inclusion, or diversity, inclusion, and equity, which has an interesting acronym of DIE. But there's no doubt that there is a requirement for infrastructure build out in rural and northern communities, particularly on the broadband side, as I mentioned. I don't know if the federal government will ever really get its act together. If I had to pick an area of infrastructure build out that is most in need, and this is actually perhaps going to sound controversial, but it shouldn't be. It would actually be if we could figure out a way to actually get clean water for all of our First Nations reserves in Canada. I view the way that we treat First Nations infrastructure as probably one of the worst things that Canada does as a country. I think that we'll hopefully see some investment there. But of course, there's always the expansion of airports and desperately needed LNG plants and different ways to get our oil and gas to Tidewater. Oh, and I have a correction from Steve, and he said that was actually a Mark Twain quote, not a Churchillian quote. So thank you for that. Mark Twain, by the way, or Samuel Clemens, also said quite famously that a gold mine is a hole in the ground with a liar on top. And of course, he was quipping about that because he actually he knew about how investment mania actually affected people, and he saw a lot of people get swindled. And he was actually pretty smart as an investor, and he actually made a killing in silver mines in particular, but also in gold mining stocks. But he saw what stock promoters could do. Okay, so next question here. Precious metals, particularly gold and silver, seem to be highly cyclical and almost unreliable for investment. What are your thoughts on these going forward, given the so-called focus on usage in technology, gold-backed currency versus oil-backed, and potential individual hoarding? Individual hoarding, I think, is going to become more of an issue, and that speaks very positively because it pulls supply out of the market. Which obviously is good for prices of stuff that continues to be traded. I don't look at precious metals as a magical asset class that one should always have a huge component of a portfolio in. I mentioned a few minutes ago that I have about 35% of my own portfolio in those. And that's because I've been building positions. over the longer term. I believe it's a significant growth area on a cyclical basis, but it's not something that should be 100% of anybody's portfolio and held blindly forever, because it is cyclical, so it requires some active management. So just scrolling down here, trying to find a couple more questions here. Oh, an interesting question here. So what do you believe the influence of Bill Gates purchasing rural agriculture lands throughout the US has against the large increase in agricultural stocks? Not quite sure what to make of it. It could be that Bill Gates is just diversifying his massive personal wealth. It could be, and I think that a fair number of listeners here might lean this way, that that it's perhaps something not quite as innocent as that. The reality is that agriculture is not farming anymore as much as it is agribusiness, and with increases in automation and mechanization of farming, scale is very difficult to achieve. We see that in the US, we see that here. Certain minimum sizes. The minimum size that you could make a living as a family farming 30 or 40 years ago, it was probably between a quarter and a tenth of what is required today. We know that from quite a number of our farming family or agribusiness family clients again. So we think that that's a longer term issue. We also want to remember as well, though, that when it comes to the price of farmland, we have to think of that as a business asset that's got a certain yield associated with it. And as interest rates continue to escalate, the price of farmland is not necessarily going to decline as much as, say, bond prices would. They could have a tailwind associated with higher food commodity prices, so that will keep the prices from going up. But if you think about farmland, if we were in a kind of a flat commodity price world, so a flat yield world, and the price of money to borrow to buy a large farming property, as that goes up, the price of the farmland or any other real estate would actually have to come down, because of course, as the servicing costs go up, the ability to service debt goes down, so the price has to come down for price equilibrium. The offset is to the upside right now, I think, with food commodities moving to the upside. But again, you always want to look at diversification of your income streams and of your business if you are in the farming situation. Okay, one broader question here. What's your management fee structure? Management fee structure is scaled according to portfolio size. We aggregate all household accounts. We're pretty competitive with the, actually we're very competitive with a typical managed account fee. We're not as low as, say, the banks are, but of course we have many advantages over the banks in terms of independence. And one of the things that we do as well is that we also include family within one household when it comes to aggregating fees. There is a question here about what Western Canadian mining companies would you recommend that produce or are involved in cobalt, copper, and lithium? That's a good question, Martin. It's not one that I'm comfortable answering specifically, because we don't do the individual company research. And also, as we mentioned, we prefer to take the approach of investing in the haystack, so in a group of producers in any given sector, because that reduces the risk of loss if there is something that happens from a particular company. So our approach is generally to use a basket of them. Oh, and have Rich has provided us a nice link to nuclear energy, and we'll go take a look at that afterwards. And we had several questions here about what's the name of the Calgary Actively Managed ETF. We're actually not going to be sharing that because that's part of our due diligence that that goes along with the work that we do. Let's see. Regarding the increase in metal costs, what will be the impact on residential and commercial construction in the next 5 to 10 years? Well, Wolf, I would say that just like what we've seen happen with the price of lumber when it comes to the price of residential construction, it's going to be a cost headwind. It's going to be driving up those costs. Of course, you see all kinds of dominoes that go through all the supply chain whenever the cost of a raw good goes up. So. Oh, and a question here. We've had quite a number of them. What is the minimum portfolio size to manage? Typically, it is a $500,000 minimum. That's an aggregate of household assets. And a nice compliment or two. Much appreciated. These are difficult to do, and they require a ton of research. Sandra and I probably put in anywhere between 20 and 25 hours each on preparing these and delivering them. So thank you very much for the compliment there. A lot of questions about what the ETFs that we've been showing. Again, we're a little bit reticent to share some of that information because it is part of our intellectual property and what our portfolio managers do for our clients. But you know, you can do a search and you can probably figure out ones that you like in each of the sectors as well. The way that we started on looking for which were the best ones to invest in was we actually started with internet searches and did things that way, and then started to drill down through all of them in all of the different areas. And one question here, we'll make it our last question from Brad. What do you think the likelihood is of nuclear power coming to Western Canada? And he says, I believe it's typically a minimum of 10 years between conception to build to operate. You're quite right about that. It could be a shorter time horizon based on the new fourth generation types of nuclear power plants. I actually think that nuclear power would be an excellent thing for Western Canada. There's still a lot of popular myth around the dangers associated with nuclear power generation because people know three names. They know 3 Mile Island, Chernobyl, and Fukushima. None of those were fourth generation plants. And Harrisburg, Pennsylvania with 3 Mile Island, the design worked, it melted on itself, nobody was hurt. Chernobyl was the result of decades of a maintenance deficit by the Soviet Union because it was collapsing economically, and that's why Chernobyl turned out to be such a disaster. And of course, how they handled it afterwards, spreading the cancer amongst the local residents was horrific. And Fukushima was primarily a location problem. Of course, what happened with Fukushima just over 10 years ago was the fact that the design of the plant itself was pretty strong, but what they didn't count on was the size of the tidal surge in a tsunami, and it washed over their protective walls, and that's what actually took out the cooling mechanisms, which led to the meltdown. So it wasn't actually a problem with the design itself; it was a problem with the location. None of those things exist with the fourth generation plants, and I think that the primary objection to nuclear power in Western Canada is purely political. I think it would be absolutely brilliant to have it here, because that would allow us to not use natural gas for electricity generation here as much as we have, instead replacing that with nuclear power, with a fabulously reliable supply right next door in Saskatchewan. Some of the best uranium deposits in the world, not the largest, but amongst the best concentrations of uranium. And it would allow us to basically take advantage of what is close to us in terms of uranium, and save our oil and gas to sell to the rest of the world. Because of course, we're certainly not in a position where, particularly with oil, we're not in a position where there's going to be electric fighter planes or electric bombers. And so that's particularly important from a long-term strategic military perspective. So I love the idea of that. And frankly, I like the idea of having an energy mix, or a buffet. And same rationale. Let's use solar if it's financially viable, and wind if it's viable, so that we can sell our oil and gas instead of burning it here for ourselves. All right, that's a wrap. Thank you very much for everybody who has been attending, and we look forward to following up with you in the next short while. And hopefully you'll be able to listen to the webinar again and get in touch with us. Thank you.